Chapter 12, Informal Risk Capital, Venture Capital, and Going Public. So, how do you finance a business? Well, the sources of funding develops through stages. You have early stage financing, which is the most difficult because you haven't really proved anything or no one knows you, and it's costly to obtain. Seed capital is usually a small amount for proof of concept, meaning stuff you've invested in there, and market feasibility studies, why will your business work? That's a big part of your business plan. Startup financing pays for developing and selling initial products to determine the feasibility of your commercial sales. Development financing is the next step or next stage, if you will. It's working capital supports the initial growth. In the third stage, the company has positive cash flow and uses the funds for sales expansion, so you plow it back into the business. The fourth stage is the funds are used before going public or being purchased, depending on what your end game is there. Your end game is probably to make money, so you could go public and sell off stocks, which then makes you money, or you can actually sell off the company to, say, a larger company. Either are excellent plans. I need to know what your plans are in this class. Acquisition financing is used for acquisitions, LBOs, or going public. Now, let's talk about risk capital markets. There are 3 risk capital markets for finance growth. Not financial growth, finance growth. The public equity market is available for high potential ventures, selling shares or selling bonds, or let's say shares to folks in the public. Venture capital market, you can have a VC provides some first stage funding for larger ventures. You can find someone who invests in companies professionally and try to convince them that you're worth investing in. They become basically your partner in it. The best source for first stage funds is the informal risk capital market, which are talking more like, hey, going to the bank, going to the local credit union, that type of thing. The private equity market provides capital for private ventures. The market consists of individuals like angel investors, venture capital firms, and private equity funds. So you can find groups that will invest in your business, basically like you're a stock. Informal risk capital market we were talking about the risk capital market in general. This is the informal risk capital market. This market is a group of wealthy investors called business angels or angel investors who look for equity investment opportunities. They basically want to take their funds, help you do your idea, and then you both profit from it. Angels provide funds for all stages, but particularly in startup funds. If you see pitch competitions, that type of thing on a formal stage, generally speaking, there are business angels in the audience listening to them. This is the largest pool of risk capital in the U.S., and the size of the number of investors has increased in recent years. The angel money available for investment each year is about $20 billion. So don't tell me it's not out there. You got to go get it. But it starts with a great business plan, which is why that's what you're doing here. Tell me how you innovate, how you create value, and I can tell you there are people out there that want to invest. Informal investors tend to be well educated. They tend to invest in firms geographically close to them, so kind of a regional deal. They make 1 or 2 deals a year, averaging $340,000. So keep that in mind when you come ask me for $1 billion. All right, it's probably not even going to be $340,000. They may join with other angels to finance larger deals if it's a bigger opportunity. So where do angel investors find their deals? Deals are found through business associates, friends, personal searches, investment bankers, and business brokers. An angel network are a group of angels organized into networks or funds, a growing and more common way to find a deal. Generally speaking, your local chamber of commerce probably knows these people, but they're going to be very guarded before they give you this information because, they don't want to ruin their relationship by sending them every Tom, Dick, and Harry. They want to send them people who have a good business plan with a solid plan. Sounds like we might have a reason for doing that in this class. Aha. Organized angel investor groups are spreading in the U.S. It's becoming more of a thing. I think it's been popularized. Become more popularized. Is that a word? In America, I think a lot of it has to do with shows like the Shark Tank. The network or fund meets about 6 to 10 times per year. Basically, anytime they want to meet, you better meet with them. Where select entrepreneurs may present their business idea. Investment is made individually or with other interested business angels. Now, crowdfunding has become a thing. Crowdfunding is also an individual investment. It can be used to pre-test a product or service. I think your generation invented this. It's pretty cool. This brings together various individuals who commit money to projects and companies they support. Reward-based crowdfunding is when individuals pledge money to a company for developing a new technology, a new cultural art project, or a new music album, or even a t-shirt. We've seen that. Lending, crowdfunding allows borrowing companies to accrue debt funds without going through traditional providers. Usually the bar is a little bit lower, but you also have things you have to pay. If you can't pay it back, that type of thing. Equity crowdfunding allows individuals to invest in private companies for a percentage share of the company. Other crowdfunding sites focus on real estate, human capital, that type of thing. You can crowdfund into, say, a real estate fund that will buy real estate, say, on coastal Florida, that type of thing. I mean, there's risk there, but there's all kinds of stuff you can get into both as a borrower and an investor when it comes to crowdfunding. Crowdfunding campaigns, successful crowdfunding campaigns take time and planning to develop a marketing campaign, execute a campaign, and provide excellent service. To determine the crowdfunding site you will use, so here's the things you have to do. Determine the crowdfunding site that you will use to raise capital. There's plenty out there. Just Google crowdfunding site. Create a video explaining what you are doing with an emotional appeal, why people should care about what you're doing, and the feasibility of what you're doing. Establish a budget showing short-term costs. Sounds familiar, doing that in this class. Indicate the specific tasks to be funded, structure some appropriate rewards, and establish a deadline for a campaign. Now, venture capital, we touched on this lightly in the last chapter. Let's dive in a little further. Broadly, venture capital is a professionally managed pool of equity capital. The equity pool is fueled by wealthy limited partners. Other investors are pension funds, endowments, and other institutions, including foreign investors. The pool is managed by a general partner, the venture capital firm, in exchange for a percentage to gain realized, so to make money and a fee. Venture capital is a long-term investment. This is a long play. This isn't, quick money back. The venture capitalist takes an equity participation and is actively involved monitoring the company and bringing needed business skills to a firm. So, an overview of the venture capital industry. The role of venture capital became an industry after World War II with the American Research and Development Corporation, ARD. The Small Business Investment Company Act, which we talked about in the previous chapter, formed the Small Business Investment Companies, SBIC firms. SBICs were the start of formal venture capital industry. Some of you were talking again post-World War II into evolving here in the 1960s. During the 1960s, small private venture capital firms emerged, usually formed as partnerships with venture capital firm acting as a general partner and a limited partner supplying funding. So you have the kind of people with money putting them into this partnership, and this partnership investing in companies they think can succeed. You have to convince them to be a recipient that you can succeed. Thus, you have to be able to make a business plan. So making a business plan might be a good idea for an MBA program where you are trying to get entrepreneurs at least familiar with all aspects of entrepreneurship. That's the point of the course. Also, venture capital divisions of major corporations were formed. So big corporations started doing this as well. And they can invest in startups. And if the startups do well, and let's say they're in the same industry, they can acquire the startup and make it a part of their company. So pretty good exit strategy if you're an entrepreneur there. Geographically oriented, generally, venture capital funds were created for economic development and vary based on state basis. Every state has a program. I've been quite impressed with South Carolina's programs where this college is located. In particular, in the upstate of South Carolina, there's been a ton of development if you think about all the corporations, big and small, that have moved to the area. The venture capital industry continued here. University-sponsored venture capital funds, philanthropic venture funds are usually managed as separate entities. Basically like a business incubator, a business investment organization under the umbrella of a university or college. The venture capital industry has not returned to the highest level invested in 1999 to 2000, which was 104.7 billion in over 7,800 deals. In 2017, this data is a touch dated because this book, quite frankly, is a touch dated, but we're trying to control your costs so you'll have more ability to bootstrap your own projects. But anyway, in 2017, the three primary industries invested in were the internet, healthcare, and business products in general. The largest amount raised from a later stage financing in 2017, but traditionally expansion stage is the largest category. So generally you get more money as the business proves itself. Less upfront, medium in the middle. Once you've proven yourself, you can get more money. The New York metro areas receive the largest amount of venture capital, geographically speaking, in the United States and probably in the world, just because that's kind of the financial capital of the world. So there's a lot of venture capital, angel investors, a lot of programs for that general area. The venture capital objectives and criteria. The objective of a venture capital firm is to generate long-term capital through debt and equity investment. So they take money, give it to businesses with terms. Either you give me a piece of equity, you make me a part of an owner, or we're going to loan you this money and you pay us back plus interest. The objective of the entrepreneur is survival of the business, of course. Return on investment, ROI, criteria increases with the increased risk of early stage financing. So the more money you put up front in an unproven firm, the more it is at risk. The venture capitalist does not seek to control a company, but usually wants at least one seat on the board of directors. They want to at least have a say. Investment criteria includes being financially committed. First-rate management teams are supported by family members. The product must also, must be unique. Product or service must be unique. It must solve a problem. It must create value. It must be innovative. Name of the course. The opportunity must have significant capital appreciation, thus, a greater ceiling for growth, so a higher ROI. Now, the venture capital process, there's a preliminary screening that begins with the receipt of the business plan. See why you're doing a business plan? Here's the thing. You turn in a crap business plan, you're going to get a crap grade, okay? Turn in a great business plan, you're going to get a great grade. Why? Because that reflects the venture capital process. You turn in a weak business plan, you're not going to get investment. You turn in a great business plan, you still might not get investment, but at least you have a chance. The business plan is your foot in the door. You must have a clear mission and objectives. The executive summary is used for initial screening. I told you guys this. I told you. If you're watching the other lectures, people just look at that executive summary, which should be written dead last when you figured out exactly what your business is, okay? People try to write it first. I don't get it. Written dead last, people will look at your executive summary. If that raises their interest, they're going to flip straight to your financials. If that is solid, then they're going to read the whole thing. Executive summary matters. The investor evaluates the business, determines the deals fit into their portfolio, whether you make sense in their portfolio. Think about like you're being a stock in their portfolio. They want a return on that stock. They investigate the industry and your management team. That's why you got to do an industry analysis, SWOT analysis of yourself and your competitors, and tell me why your management team is the exact right team to put this together. And what holes do you have, and how do you plan to address it when it comes to your management team? The second stage of the agreement is on general terms. The third stage is detailed review and due diligence. This is the longest stage, takes anywhere from 1 to 3 months. The last stage is final approval, includes a comprehensive investment memo. So we deal largely in this course right here, because it's where you start. And if you can't get your foot in the door with a business plan, you're not going to get any money anyway, so none of this other stuff matters. This is where we start. Then put everything else you got in this degree together, and you can navigate these. Makes sense, right? Locating and approaching venture capitalists. Only approach firms who may be interested in your opportunity. Research prospective firms carefully, including regional and national venture capital associations. Approach a venture capitalist in a professional business manner. Have your stuff together. Seek an introduction. Venture capitalists tend to focus on referrals. Select the right venture. So your net worth is your network, baby. Network equals net worth. So always be networking. Select the right venture capitalist and don't shop your deal around. Find the right one. Don't present it to everyone because they want to have exclusive rights. Bring one or two members of the management team. Not the whole team. You don't want to freak them out a little bit. Develop a brief, well-thought-out oral presentation. It can be anything from an elevator pitch to a 10-minute, let's say, presentation, which is much more likely you're going to get a lot less than 10 minutes. You might get a minute. A favorable first meeting may lead to additional meetings and reaching an initial agreement on terms. If rejected, select several other non-related firms to go find somebody else that you can sell it to. And then always learn. It was an interview or a sales pitch or whatever, or elevator pitch. Always learn what went well, what didn't go well, what can I improve. Okay? You get better every time. Valuing your company, the factors in valuation. So what value should you place on your company? People typically overshoot this, but the factors in valuation include the nature and history of the business, the outlook of the economy in general, and the industry in particular. The book value, net value of a company's stock, and the company's overall financial condition. The future earnings capacity with data to back it up is the most important factor. That's going to be something I'm going to look at in your business plans. The dividend paying capacity is the future capacity to pay rather than actual dividend payments. An assessment of goodwill or other intangibles is the sixth factor. The seventh factor is assessing the previous sale equity. So like if you sold it before or people invested in it before, that's kind of like a recent appraisal, if you will. And the final factor is the market price for a similar company's equity. So you can compare to neighboring companies in the same industry. Ratio analysis. Calculations of financial ratios can be used as analytical and control mechanisms to test the financial well-being of a firm. These ratios measure the financial strengths and weaknesses of a venture, but they are only one control measure. There are industry rules of thumb when interpreting the financial data. The different types of ratios, most popular here are liquidity ratios, how much cash flow, that goes back to cash flow, it really does. Liquidity ratios, activity ratios, leverage ratios, how much debt you have, profitability ratios, that describes a lot of profitability. We're going to go through these I think one by one here. Liquidity ratios up first. The current ratio measures the short-term solvency of a venture and its ability to meet its short-term debts. So a ratio of 2 to 1 is favorable, but compare with your industry standards. Current ratio, so your assets, like things you own, things you put in the positive category, over things you owe. Okay, so you'd rather this be 2 to 1, so like 100 to 50. Okay. In terms of dollar figures. The acid test ratio is a more rigorous test of short-term liquidity of a venture and eliminates inventory, so it takes like things you have on your shelf out. The ratio of 1 to 1 is favorable, so you want to take your current assets, so same thing here, current assets over liabilities only from current assets, you take out your inventory. So this lets you know, okay, so if you're a factory that makes luxury golf carts. I don't know why that just popped in my head, but you would take, okay, the value of the factory, the machines, the human capital, cash on hand, but take out the actual golf cart sitting in your warehouse and divide that by liabilities. Now it goes from 2 to 1 to 1 to 1 is ideal. So it lowers the bar slightly, but this inventory they take out in an acid test ratio just to see what you would have if something happened to your entire inventory. Activity ratios, second one here. The average collection of period ratio indicates the average number of days it takes to convert accounts receivable to cash. Why? Because cash flow is king. Compare the result to your industry standards. So you need to look at your competitors and try to get a read on what their ratio is. That way, if you say, hey, ours is like 4 to 1, it should be 2 to 1, like on the previous one. But everybody in this industry is 4 to 1, then that's a justification for being 4 to 1. Average collection period, accounts receivable divided by the average daily sales. So this is how many sales you're making in the denominator here. And accounts receivable is what you're actually getting. So how do you convert sales into actual funds coming into the business, which then affects your cash flow, which then has the ability to reinvest in your business and also pay your people. That's important. So they keep showing up. So what does your average collection period look like? The inventory turnover ratio measures the efficiency of the venture in managing and selling its inventory more quickly. A high turnover rate is a favorable sign. So you can take stuff you've produced, put it in the market, and get money back. How fast you turn over your inventory, so your cost of goods sold, so what you put into them, divided by your inventory. Obviously, if you can move things out the door more quickly, you can move dollars back in the door more quickly, and then your activity ratio actually improves. Third category here, leverage ratios. The debt ratio assesses the firm's ability to meet all of its obligations, both short and long term. It also measures risk because the debt consists of a fixed commitment of interest and principal payments. It's simple. How leveraged are you? Your debt ratios, your total liabilities, what you owe over your total assets. Now, you prefer this number to be small, right? But particularly in the beginning, you're going to have potentially a lot of liabilities if you can get in the door with convincing someone you have a winning business idea with your business plan. Now, over time, you want this debt ratio to go down, but debt can be used to get things done. The debt equity ratio assesses the firm's capital structure. It measures the risk to creditors. The more debt you have, the more risky you are. By considering the funds invested by creditors, that's debt, and investors, equity, You'd love to have, more equity than debt, but sometimes that's not the case. The higher percentage of debt, the greater the risk. So again, debt to equity ratio, what you owe versus what people have plowed into the business. If people put more into your business, you're more attractive and less risky. The net profit margin ratio represents the ability to translate sales into profits. So how do you get down at the end of the day? Use your gross profits instead of net profit to provide another measure of profitability. Net profit margin. So what do you get to keep as a business? Your net profit over your net sales. So how good are you at converting what you're doing, what you're selling into actual profit? The better you are at this, the more profitable you'll be. Return on investment measures is the ability to manage the venture's total investment in assets. Substituting stockholders' equity for assets calculates a return on equity. So your ROI, your return on investment, is your net profit divided by your total assets. Tell you what, the best business plans I see have these things. Okay, have these ratios, or at least take a stab at it. They're going to want to see it. I would like to see it. So make this your stretch goal to include these in your business plan. General valuation approaches. One widely used approach assesses the price of comparable publicly held securities, if one can be found. The present value of future cash flow adjusts for time value of money in the business of economic risk. Think back to macroeconomics where you learned that. And probably your financial management class. The replacement value is used for insurance purposes. Let me back up. If you didn't have a financial management class, or you're coming from a different industry, hopefully you have someone on your team who can do that. If you have no one on your team, you need to put that under the weaknesses assessment of your company, and how will you address that? By getting someone who's had financial management and or macroeconomics. Again, the replacement value is used only for insurance purposes. So building burns down, how do you replace all your equipment? Heaven forbid that happens. The book value adjusts for depreciation and inventory. There's some accounting. The earnings approach provides the best estimate of probable return on investment. At the end of the day, that's what people want to know before they invest in your company, be it in debt or equity. The factor approach uses 3 weighted factors to determine value: earnings, dividend paying capacity, and book value. The approach given the lowest value is liquidation value, so how fast you can move into cash holdings. So that's less important right up front. What's more important is your leverage and if you're going to be able to generate enough profit to stay cash solvent. General valuation method. This approach determines how much of a company a venture capitalist will want for a given investment. This approach considers the time value of money to determine the investor's share. So the percentage of the venture capitalist's ownership, so how much of the company they're going to own, is determined by their investment divided by or multiplied by the number of VCs. So and then year 5 profits times the price earnings multiple. So the reading goes into much more detail here, and I don't want to get bogged down here because I really want to see these in this particular business plan. But if you are a VC, one thing you want to consider is the time value of money to determine your share. So when you hear on Shark Tank, hey, for a 51% stake, which is a controlling stake in a company, we're asking you for $500,000, you need to figure out if that $500,000 today is going to be more money or less money in the future. If it's less money in the future, you don't do it. If it's more money in the future, depending on the percentage return, the return on investment, which we talked about previously, you make the deal. Okay? It all starts here. Read more about this. This is really more important from the venture capitalist perspective than it is necessarily from where you guys in this course is coming from in terms of being an entrepreneur. But definitely read more about this because what you're going to be asking them, you're going to be wondering how, what percentage you're going to offer them and at what value. The general valuation method, again, this slide doesn't do it enough justice. Make sure you're reading that particular part of the chapter. I'll try to look up and see what page it is and put it in the notes there. Evaluation of an internet company. The valuation process of an early stage internet company is different from the traditional valuation process. This is something that's more modern day. The qualitative portion of the due diligence carries more weight than other evaluations. Qualitative, remember, a non-number. There's just a qualitative aspect of, hey, well, this, it's just another internet company. Will it work? What is the value proposition? Is it innovating? Is it creating a solution for somebody's problem that people are willing to spend money on? After analyzing the market size and potential revenues of a company, the investor examines the management team. Through a technology firm, though a technology firm may sell for tens of millions of dollars, it is uncommon. Generally speaking, they are on average acquired for much less. The internet, people have a bit of success bias here. They only hear about the crazy success stories. They don't hear about the thousands, if not millions, of moderate successes to complete failures. The internet and tech firms are changing how companies are funded. Valuing a company based on talent may be a growing trend, and one of that remains within the tech industry. So who you have matters. But if you don't do a good job in your business plan explaining who you have and why I should invest in you because of who you have, you don't get past that first stage we talked about in the previous chapter. Deal structure. Another concern is deal structure. The terms of the transaction between the entrepreneur and the funding source. The needs of the funding source include required rate of return, timing and form of return, the amount of control desired, and the perception of the risk involved. Can you convince them it's worth the risk? The entrepreneurs need to include degree and mechanism of control, like how will the company work, the amount of financing needed, why is it that amount, do you have a solid budget that explains that well? Hint, hint for your business plan and the objectives of the firms. I will add in here, I'll give some bonus points for people who address human flourishing from a Christian perspective in the entrepreneurial and endeavors. How will your business advance the kingdom of God and lead to human flourishing through creating value and innovation? Very lightning quick, too quick overview of Chapter 12, Informal Risk Capital, Venture Capital, and Going Public. Look for in the notes, I'll try to add the specific section on the venture capitalist percentage. As always, available via your office hours. Otherwise, I will see you in the next lecture. Thanks.